Hey, good evening, everyone. Welcome to January 2025, our first edition of All Access Belize. We welcome you all. Thanks again for joining us. Again, today's topic is about self-directed IRAs. I'm coming to you from Chile, Belize. It's 72 right now, but I'm not complaining because I left. It was like 23 in Dallas yesterday or Monday, and Nate's in Phoenix, and it's pretty cold right there for him. So, welcome everybody. Nate, welcome. Thank you for taking time out of your busy schedule. Tell us a little bit about yourself and kind of, you know, your family, where you're from, what you do now, and just kind of let us know a little bit about you.
So my name's Nate Hare. I'm the Vice President of Sales and Strategic Relationships at Directed IRA. But I will tell you from the time that I graduated college, I live, eat, breathe, and sleep real estate. I've been involved in real estate. I've been a residential loan officer is where I kind of started my career. I've been a landlord. I've had my real estate license with Keller Williams. I still have my mortgage loan officer license. However, for the last almost 13 years now, I've been specifically focused on teaching people how to use retirement plans, whether that's 401ks, IRAs, TRS, TSPs, money you've got saved up over here that you don't think anything of it, and actually taking that money and investing in things like real estate, rental properties, whether that's international or domestic, syndications, promissory notes, cryptocurrency. I mean, the list goes on as to what you're allowed to invest in a quote retirement plan or a tax advantaged plan. And when I learned about this back in 2012, I wish I would have learned about it 10 years prior to learning it. And I realized nobody that I knew even understood that this was possible. So I took it upon myself to say, you know what, I'm going to teach more people about this because I think everybody needs to know at least what their options are when it comes to their retirement assets. And that's what I do, eat, live, breathe, and sleep these days.
Yeah, I know we talk to a lot of people and they're not even familiar with they could buy property with their self-directed IRA. And I always kind of liken it to, when you go to McDonald's and they ask you if you want to upsize your fries. So when people are
Mhm.
buying property, I'm like, hey, you want to buy another property with your self-directed IRA? It gives them kind of that, you know, just to get them a little bit outside of the stock market, but they can, invest in something. So yeah, so if you have any questions, I know we're kind of, from a 40,000 feet angle right now. But Nate's going to share some slides and go over some stuff, and then we'll probably have some questions. I'll have some questions for him. I know no one likes to be first when it comes to questions, but don't be bashful. This is really there's nothing off limits. Good, bad, ugly. Nate, most people here are looking or interested in Belize, but also people. This really pertains to anywhere in the world. So it doesn't have to be Belize. Really, the only caveat is you have to be an American or have, some 401k money. There are other, if you're Canadian, there are RSSPs, I believe is what they're called, or RSPs. So, and I'm sure other countries have other things like it. But we're mainly talking tonight to our American investors, our American real estate people, or people interested in Belize that are American, because this mainly falls under that. So Nate, go ahead and you can take it from here and tell us what you need or from us.
Oh yeah, if you can see my screen, just give me a thumbs up and I'll fire away. And kind of like David mentioned, this is just kind of the tip of the iceberg. I've been teaching all sorts of courses related to IRAs, investing in specifically real estate, but IRAs just in investing in alternatives is what I'm an expert in at this point. But to go over it in 30 minutes, we're just going to touch on the tip of the iceberg. I expect you guys to have questions. I expect you to have questions even after this when you sleep on it and go, you know what? I didn't ask this question. I want to think about this. So it's perfectly fine. And trust me, this isn't taught to the masses. So most people don't even get subjected to this information. You guys are lucky tonight. So just a little background about myself. Again, like I said, My name's Nate Hare. I'm a certified IRA services professional. What that means, it's just a nerdy term. That means I pass a test by the American Banking Association. That means I know a lot about IRAs and 401ks in general. However, my experience in real estate has brought those two worlds together. And what I'm here to teach tonight is just what are you really allowed to do with a retirement plan? Now, why is it even important to talk about retirement plans? I think the biggest reason it's important to talk about retirement plans is most Americans have most of their money in their retirement plan. There's $40 trillion in US retirement plans. That's 40 with a T with a trillion. Okay. That's where most Americans' wealth is. And when you ask most people what their retirement is invested in, most people have no clue. They can't even tell you. They might say, oh, it's with Fidelity. Yeah, but what is it invested in? Oh, it's some, international growth fund. What are companies that are, oh, I don't know, right? Most people have no clue what's in their retirement plan. And that's fine. But to me, I think if it's your largest bucket of wealth and it's the bucket that you rely on the most, shouldn't we be more hyper focused as to what's it invested in? And should we invest in things that somebody tells us to invest in, or should we invest in the things that we're more knowledgeable about? And at least for myself, I find more people, whether they're a real estate professional or not, just understand how real estate works versus understand how the stock market works. Give somebody a 3 bedroom, 2 bath house and they know they got to get it rented. They know it appreciates over time and they know that there's cash flow opportunities. But tell people how to make money in the stock market. Most people don't know yet. 98% of our wealth, our $40 trillion, is invested in the stock market. Very little of it is invested directly into real estate or alternative assets, which I'll list here in a second. What is available as far as an investment inside of a retirement plan. Now, even though I'm an investor, I'm not giving you guys tax leader investment advice. I'm also not here to pitch Belize or pitch America or pitch anything like that. All I'm here to show you is what does the tax law say when it comes to what we're allowed to invest in with a retirement plan, whether it's 401k, IRAs, or otherwise. Okay. What are some of the rules and regulations you want to stay away from? What are the no-nos when it comes to self-direction? What are the types of plans you can self-direct? There's more than just one plan that allow you to buy alternative assets like real estate and get Uncle Sam off your back. And I think that's the biggest thing that investors look for is how do I buy real estate and pay no taxes? One of the easiest ways to pay no taxes on your real estate gains is by buying real estate inside of an IRA. Okay. So we're going to talk a little bit about that. And this is just for education purposes only. So what are you actually allowed to own inside of a retirement plan? Well, ever since the mid 70s, the investment options have been the same. Okay. There's only two investments on this planet you can't own in a retirement plan. And those investments are life insurance contracts and collectibles. Life insurance contracts, you can't have your IRA have a vested interest to see somebody else die because they might die a lot sooner if your IRA got paid out on that. So they just don't like that type of investment inside of a retirement plan. And collectibles are specifically defined works of art, classic cars, paintings, hard to value assets they don't want inside of a retirement plan. Anything outside of that is fair game. Okay. As a general rule of thumb, if you can drop a purchase contract to buy something, your IRA can be the buyer. Okay. If you can hold title to something, your 401k can be the owner on that title. The only problem is we only hear about the traditional investments, and most people think those are their only investment options when it comes to their retirement plans. Fidelity, Charles Schwab, they'll allow you to hold stocks, bonds, mutual funds, ETFs, REITs, and CDs. We call those traditional investments. But if you ask Fidelity, hey, I want to buy a rental property in my Roth IRA, what's Fidelity going to say? No, you can't do that in an IRA here. That doesn't mean you can't do it in an IRA at all. That just means you can't do it with Fidelity. The reason being is because Fidelity is a licensed securities brokers. They sell financial product. When you have your retirement plan with them, they only hold what they make money on. Okay. When you have an IRA, a directed IRA, first of all, those IRAs are completely the same. Okay. If anybody has a Roth IRA at Fidelity, the Roth IRA, directed IRA, completely the same thing, same type of entity. The only difference is with our account agreement with our client, it says we'll hold anything the IRS allows, but you have to tell us what the investment is. You have to find the investment. You do your own due diligence. We trust you. And then you tell us what the investment is, and we'll tell you the documents we need as your IRA custodian to buy it inside of your IRA. So when we have a wide open agreement like that, the spectrum of investments that you're allowed to invest in go very, very large. Here's some of the investments that we hold for our clients right now inside their retirement plans. Investment real estate, that could be rentals, flips, it can be domestic or international, it doesn't matter. The IRS doesn't care. Okay. So rental property, land, precious metals, cryptocurrency, that's your Bitcoin, Ethereum, all of that can be owned in an IRA. Investments into private businesses, startups, energy, natural gas, mineral rights, tax lien certificates, promissory notes. I actually do promissory note investing. That's the way that I grow my retirement plan, is just by being a hard money lender out of my Roth IRA. Talk about easy money with on the sweat equity of somebody else. But these are all investments that are allowed to be owned inside of a retirement plan. We call them alternative assets. The only difference is if you want to own those in your retirement portfolio, you have to have an IRA with a company like us, directed IRA. Now, I will, truth be told, most of my clients have an IRA at Fidelity and they have an IRA directed IRA. You're not limited to how many IRAs you're allowed to have. In fact, you can have as many IRAs as you want. And the good thing about having multiple IRAs at two different custodians that hold different types of assets is now that's real diversification. Diversification to me is not high risk mutual funds, medium risk mutual funds, and low risk mutual funds. That is one asset class out of many. The ability to hold some paper assets through stocks or bonds, and the ability to hold some alternative assets through a self directed IRA really lends itself to having true, proper diversification. And I will tell you this, there have been studies, there's numbers out there that show the larger the value of an IRA, for example, let's say $5 million and above. And they did an audit on this, by the way, back in 2020. It was in a Forbes article. They audited about 27,000 IRAs to look up the asset makeup and see how many people are really investing in alternatives. And they found that of the 27,000 IRAs that they audited, only about 2% of the IRAs or the assets in those were alternative assets, the things on the right-hand side. But as you took just the IRAs that were about valued above $5 million, what was the asset makeup of those IRAs and alternatives? It went all the way up to 25%. So the rich and the wealthy have been investing in alternatives, whether it's startup businesses or real estate, for decades. We're just now becoming told that it's an option because most people didn't even realize that they had this option available to them. So when it comes to, and you've probably heard this term, it's probably in the title, but when I say self-directed, just get that out of your head. It's a marketing term. A self-directed IRA is not a type of IRA. The only reason we say self-directed in our field is because, again, we don't have investments to sell. Okay. You have to tell us what the investment is. You have to direct us to go buy the asset that you want to own in your IRA. And I'll talk about how that works. And I've got a case study to show you how the process works. How do you take an IRA and buy a piece of property? Well, you do that through us, and I'll show you how that's done. But when you look at the types of accounts that we have here at Directed IRA, they're no different than the accounts you would have at Fidelity or Charles Schwab. We've got three categories of plans that you can set up accounts here with us that can own real estate and all the alternative assets that I showed you. Personal plans, traditional IRAs and Roth IRAs. Traditional IRAs make up, your old 401ks, your rollover IRAs. Traditional meaning it's just a pre-tax bucket of money that's already been rolled into an IRA. Those IRAs can own real estate or own alternatives as long as you've got that IRA parked here. Roth IRAs, probably one of the greatest wealth building vehicles on the planet. I could talk all day on that, but I know we don't have all day. But self-directed Roth IRAs really lend itself to owning real estate. Just think about this. I've got a client that owns 12 rental properties in a self-directed Roth IRA. Okay. Now, the beautiful part about a Roth IRA is once you've had a Roth for 5 years and you're above the age of 59 and a half, your Roth IRA becomes a tax-free bucket for the rest of your life. You have what's called qualified distributions. That means every time you take money out of your Roth, you never have to pay Uncle Sam a dime for the rest of your life. So when you own cash flowing, appreciating property, like my client owns 12, owned in his self-directed Roth IRA, the interesting thing that happens is that the Roth IRA is not a taxpayer. None of these plans are taxpayers. Since the properties are owned by his Roth, the renters pay rent to the Roth. And then he just takes a recurring distribution every single month of all those rents to himself. And since it's a qualified distribution, he pays no tax on those rents and no tax on those distributions. The next month, he takes another $30,000 out, no taxes. The next month, the same thing, the same thing. He's taking close to $400,000 of distributions that he'll never have to pay taxes on. And here's the beautiful part about his Roth IRA. It goes up in value, even though he's liquidating it with that much in distributions, because he's not touching the principal of the real estate. Real estate goes up in value. He just lives tax free off the cash flow. You see, when you marry those two ideas together, you can see how powerful this is. And you're probably thinking to yourself, well, why aren't they teaching this in school? I'll tell you why they're not teaching this in school. The IRS likes to get our tax dollars. They like to see us grow our retirement in a traditional type IRA because they get to tax you for the rest of your life. But with a Roth IRA, they don't. So you can really get off grid by just investing tax-free accounts like a Roth into things like real estate that, again, might have healthier returns or multiple streams of income that can feed your retirement versus you working longer, paying taxes, and working till the day you die. So those are just the personal plans that can be self-directed. I assume a lot of people on here might be self-employed. So if you're a real estate agent, you're a broker, a loan officer, if you have some self-employment income, Schedule C, 1099 income, there's two other options for you that are available. SEP IRAs and solo 401ks can also be self-directed. I'm not going to spend too much time on these. I will tell you, you can larger contributions in to these plans, if you're really looking to shelter more of your earnings away from Uncle Sam that he can't touch forever, call us, inquire about some of the employer plans. And the beautiful part about being self-employed, you can still have a Roth IRA and also have, let's say, a Roth 401k. So if you're really trying to burn both ends of the stick and you've got some Schedule C 1099 income, look at both of those categories, one and two. And then here's the plans that almost nobody talks about, but I love to talk about. You can also self-direct your health savings accounts. And I bet 60% of the listeners have one of those. They didn't even realize they can invest it, let alone invest it in real estate. But those accounts work like a Roth IRA in the fact that they grow tax-free, but the distributions come out to pay your health expenses tax-free. And same thing with the ESA. ESA is short for Coverdell Education Savings Account. It's another account that grows tax-free. However, the distributions you take out of an ESA can be used to pay for your kids or your grandkids' education expenses with tax-free dollars. Things like tuition, tutoring, room and board, books, computers, your home internet bill, for example. So self-direction not only allows you to set yourself up for a tax-free retirement, but if you utilize the plans that can be used today, be it a health savings account or an education savings account, you can actually have the investments in those plans pay for current expenses that you're facing today in your working years when it comes to health expenses and education expenses, which are two of the fastest growing or fastest on the rise as far as, how it's affecting us as Americans in our back pocket. Now, when you self-direct, you want to think about how do you want to spend the money? That's where you get your benefit from these accounts. Is the trade-off is with the IRS, it says, hey, we're not going to tax these plans provided that you invest this for later or you invest it for your retirement. Okay? So you get your benefit from the distributions. Okay? But if I go back here, all of these accounts by definition are considered tax exempt trusts. You're just the fiduciary of the trust. Your job is to find it investments, grow it, and then you live tax-free off the distributions or tax deferred off the distributions. But think about how the investment is going to benefit you in retirement. Think if you want to pay taxes on the distributions, like in the traditional IRA, or would you rather live tax-free and have those distributions through a Roth IRA? The reason I say that is anybody nowadays can have a Roth IRA through what's called conversions. Okay, if your CPA tells you make too much money to have a Roth IRA, fire them and find somebody that's opened the tax code in the last 10 years. Anybody can have a Roth IRA as long as you've got a traditional IRA and you got some money sitting there in a pre-tax account. You can pay taxes on it to move it to a Roth IRA. So just food for thought. Again, if you got questions on that, just ask me after, or you can schedule a call with me. So let's actually talk about the process. Okay, we talked about the accounts, we talked about the tax benefits. How does this actually work? I kind of broke this down. I want to oversimplify this into 3 steps. If you want to take an IRA that you have now, if you want to move it over and start investing into properties in Belize or properties in your own state, wherever the case may be, we don't tell you, you tell us. You first got to open an account with us. Takes as little as 5 minutes. You'll go online. I've got a QR code here at the end. You can just scan it if you like. You open an account, and then the next step is you fund it. There's 3 ways to fund it. You can fund it with a contribution. Nowadays, if you're, I'm sure most of you guys are aware, you can make contributions for last year to most plans up until your tax filing deadline. So that goes for your traditionals, your Roths, your SEPs, your solos, your HSAs, even your ESAs. You can still make contributions for last year. And since we're in 2025, you can make your contribution for this year. You don't have to wait until the end of the year to make a contribution. So we have a lot of clients that are making double the contributions right now to all their plans. Why? Studies have shown the earlier you contribute, the more wealth you have. Most of the rich and the wealthy don't wait till their tax filing deadline to make contributions. They wait till the first of the year and throw their contribution in as early as they can. The reason being is they give themselves a whole 16 months ahead of everybody else to get that money growing tax free. So just again, just retraining the way that we were taught to think about these accounts as, oh, it's like a last minute thing. I got to make my contribution, or my CPA told me I need to make a contribution. Flip the switch. Most wealthy make their contribution early in the year. They don't wait for anybody to tell them it's time to make a contribution. Most of our clients will transfer money from an existing IRA. So if you've got, let's say you've got $500,000 at Charles Schwab or Fidelity, and you want to buy a $250,000 rental property that Fidelity won't facilitate, all you got to do is open an IRA here, the same IRA you have at Fidelity, fill out what's called a transfer form. We send the transfer form to Fidelity. They wire the funds over as an IRA to IRA transfer. This has no tax consequence on you. Okay. This is not a distribution. This is just moving money from one IRA to another IRA. Now, if you've recently left a job, or maybe you left a job several years ago and you've got this looming 401k that's sitting out there, or a 403b, or a TRS plan, a 457 plan, those plans can also be rolled into an IRA or into a self-directed IRA. But that would be the 3 most common ways to fund your self-directed IRA: contribution, transfer, or rollover. And then once the account is funded, you're going to tell us what the investment is. Okay. You're going to work with our investment team. And we usually want 2 things from you in order to buy an alternative investment. One is just we call it our direction of investment form. It's just a fill in the blank form based on the investment that you want to invest in, whether it's real estate or a note or an investment into a private company, a private fund. We have specific direction investment forms for those, because those are the most common. And then if it's something weird, I have a client that owns a pineapple farm in his IRA. I have another client that owns a thoroughbred in his IRA, believe it or not. We've got a direction of investment form for the weird stuff. But it's just a fill in the blank form. Now, what that form does is that's you as the client giving us the authority to make the investment. It's like pushing the button at Fidelity. It's like, directed IRA, I want you to buy this. And then with that form, we just need a copy of the agreement. Okay. And on the agreement, very, very important, you need to use the name of your IRA so that we're buying it in the name of your IRA. For instance, if I have a Roth IRA here at Directed Trust Company, that's our company, the name of my Roth IRA, the vesting that I'll use on any purchase, is Directed Trust Company for the benefit of Nate Hare's Roth IRA. Nate Hare is not buying this property. Nate Hare's Roth is buying the property. It's a completely different entity. Think about it this way. If you ever bought stock in a Roth IRA at Fidelity, is that owned in your name, or is it owned in the name of your IRA? It's on the name of your IRA. If they actually showed you the stock certificate would read the ownership of Fidelity Investments, FBO, your name, and IRA. Okay. The other thing they don't do, and this confuses most wealth advisors, they think, well, why would you buy real estate in an IRA? Do you realize all the tax and penalties you're going to pay if you take the money out of your IRA to buy real estate? That's not what we're doing at all. When Fidelity buys stock, they don't take money out of your IRA as a distribution to go buy stock. They don't send you the money and then you go buy it on New York yourself. That's the same thing that we do. we exchange assets of cash, assets of real estate. We don't send you a check and then you go buy it. You tell us to buy it in the name of the IRA. And that vesting is very important because that's going to show who the owner is. You're just quarterbacking the deal and showing us what you want your IRA to buy. And everything is purchased in the name of the IRA. So it's not a distribution to you. So let's kind of look at how this works. So this is a friend of mine, Denise, who's up in Virginia. Okay. Denise had recently left her old job. This is many years ago. This is about 2014, I believe. She had left her job. It was the first time she had access to her old 401k, and she decided that she wanted to buy real estate instead of buy stock. So what she did is she opened a self-directed IRA here. And now with most 401ks, I will tell you, they're pre-tax. They're like a traditional. So usually those 401ks roll into a pre-tax IRA, and that's what it did for her, a traditional IRA. But what she did, because she was in a low income year and she realized, I'm not going to retire on 375,000. I need more like $3 million to retire on. So I'm going to pay the taxes on the 375 first. And she converted her traditional IRA to a Roth IRA. And some people were like, oh my God, she paid taxes on 375. Hold that thought, because you'll see how much in taxes she saved by doing that. But in this, long story short, she set up a self-directed Roth IRA. Okay. She went out to a local real estate investor club. She found an investor and she liked the deal. They were selling a 4-unit property up in Virginia, and she wanted this bought in her Roth IRA. So she does all the legwork. Okay. We don't sell the property to her. She found the property. She negotiated the terms. She did all the legwork that she would have done as if she was buying it herself. Just the buyer on the contract was her IRA, Directed Trust Company, FBO, her name, Roth IRA. She sends the contract to us. We sign as the buyers because we're the custodian. We send the earnest money of $5,000 directly to the title company. We don't send it to Denise. We send it right to the title company. It's an asset expense. Then we work with the title company. We sign the whatever documents there need to show that we're buying this property in the name of the IRA. And then we send the final funds to close. And then the title company sends us the deed. We hold the deed that shows Directed Trust Company, FBO, Denise Roberts Roth IRA owns the 4-unit property. Just like Fidelity holds stock certificates, we hold deeds. Now, once the Roth IRA owns the 4-unit property, all expenses need to be paid out of the Roth. That's a service we provide too. So Denise needed to pay her contractor 20 grand. She fills out a payment authorization to us, sends us his invoice. We send 20 grand out of her Roth straight to the contractor. And then same thing with income. All the income on the property comes back to her Roth IRA, which pays no taxes on the income. So on this particular property, she was netting after expenses about $4,200 a month. And she had a property manager in place. The property manager rented it, collected the rents, paid whatever expenses needed to be paid, and then sent Directed IRA the net proceeds, okay, that were put back into her IRA as profit. Now, some of you might be thinking, well, hold on, Nate, that's way above the contribution limits for a Roth IRA. You're only allowed to put $7,000 in a year. Contributions are what you add to it out of your pocket. This is income. Income on an investment is unlimited. Depreciation on an asset in a Roth IRA is not a contribution. That's income. That's profit. You're not limited on profit. Okay? And she also was not taking a distribution to buy this asset. We bought it in the name of her IRA as her IRA custodian. So after 2 years, this was how her investment looked in her Roth IRA. She had it appraised, or she had a BPO. She thought it was worth about 497,000. Good job, Denise. And she had collected, or her Roth collected, just over $100,000 in rents over the first 2 years. That gave her a total return on investment of 51.13%. And the funny thing is she told me this was a base hit, Nate. But it was a base hit. This was the best that she had ever made in her retirement plan. She made more on this one deal than she had made in almost 10 years of having it locked up in her 401k. And she did this in 2 years on a deal that she picked in an area that she was comfortable with. So she was in control from beginning to end. She just worked the investment through us as her IRA custodian. Now, when she gets to 59 and a half, whatever that Roth IRA is worth, and now it's actually worth close to about $2 million. She's also sold this property, upgraded to some smaller multifamily and some other investments, but she'll have a continuous bucket of cash flowing, appreciating real estate in a Roth that she'll just live tax free forever on. So good job, Denise. Her retirement is pretty much done. Okay. Um, I'm going to skip this one because I want to take questions on that. And this is just my own personal example of me lending. But if you guys want the rest of this PowerPoint slide, just shoot me an email. I want to kind of wrap it up and take questions and give you a special promo. If you guys are ever interested in opening an account, again, you don't need to do it right now. I'm sure a lot of people have questions. You can at least schedule a call with me or anybody on my team by scanning that QR code. You can email me questions if you have questions later at nate.hare@directedira.com. And again, just keep that promo in mind. That's my personal promo in the event that you guys want to open an account and save $100 off the top. So I hope that was helpful.
Man, that was awesome. Yeah, y'all go ahead and take a screenshot of that, and you'll also get a copy of you'll get a copy of this will be on YouTube forever. So it'll be good to have. And we'll email you for those that are on and those that signed up and are not on. You'll get the replay of this. So if you have any questions, feel free. It doesn't have to be about self-directed IRA, it can be anything. Belize related or not Belize related, investment related. If I know it, I'll answer. If I don't know it, I'll tell you and I'll get the answer and Nate as well. I do have a couple questions for Nate. Since we are, since you were talking, some of these I know, but I just want to ask the question, just for your benefit. But this one I don't know, and I'd like to hear your thought on it, Nate. So you said that we can have 3 or 4, 5, 10 IRAs, right? The maximum contribution is what, 7,800 a year?
Yeah, if you're talking the personal plans, traditional Roth, 7,000 if you're under 50, 8,000 if you're above the age of 50. So
Okay,
those limits are the same for all of your IRAs combined. You could still have multiple IRAs. And the reason people do that is because, you don't have to shut down your Fidelity account or shut down your Charles Schwab account just to self-direct. You just need to open up another IRA and move whatever money over that you need to invest in alternative assets with us. I had a client at one point have 35 IRAs parked at different places with the different, there was another piece to that story, but that's the most I've seen one person have. And again, there's no limit. There's only a limit on how much you put in annually, but there's nothing preventing you from opening up at different places. And you'll want to do that if you want to invest in all the asset classes available to us out there.
for sure. Now, is that 7,800 per one you set up? So like your client that had 35, could he
Mhm.
do 7,800 for each of them, or is it
No, it's
7,800
per
for
per
all of them?
category. Yeah, per category. So the personal plans, which include traditional Roth, it's a limit on personal plan contributions. So you can only throw 7,000. If you throw 7,000 in a traditional, you can't throw anything in a Roth, right?
Got
If
it.
you throw 7,000 in a Roth, same thing. So it's 7,000 is the max contribution to personal plans. 8,000 if you're above the age of 50. So they let you throw in an extra 1,000 if you're above the age of 50.
Okay. And on the if you're self-employed and all that, are there some of those plans where you can, you know, really do a lot more in contributions?
Yeah, so if you don't mind, let me can I pull this back up just so
Yep.
people can follow along? Let me do this. Yeah, so and I have actually a slide. If anybody wants the PowerPoint, I have a slide. I have extra slides that go over the pros and cons of each one of these plans and also the contribution limits. So with the SEP and the solo 401k, for example, the contributions are much larger than the personal plans. If you're under the age of 50, you can throw up to $70,000. So it's not seven, it's 70. Add an extra zero to that. So $70,000. The solo 401k does have a catch-up contribution. SEPs don't, but solos do. You could throw an extra 7,500, or is it 6,500, 7,500? Now I'm losing my train of thought. But there is a catch-up. So I believe it's 76,500 is the max you can throw to a solo 401k. Now, the solo 401k also does give multiple buckets that you can put in. The reason why that's important is because one of those buckets can be a Roth bucket. So, solo 401k is great because you can make large contributions, 70 or 76.5, but you can also have the majority, if not all of that, be Roth money. Now, I don't want to get overcomplicate things, but if you go to our website or follow our CEO Matt Sorensen, we do a lot of education on something called the backdoor mega backdoor Roth. The mega backdoor Roth is a strategy to get $76,500 in Roth money through a solo 401k. So again, employer plans allow for larger contributions, but you do have to be self-employed and you do have to at least show that amount of Schedule C or 1099 income, at least that amount to throw that amount in.
Yeah, good stuff, good stuff. And so yeah, there we're just going to touch on a lot of this. So you definitely want to get more familiar with it. I suggest you all schedule a call with Nate. So I like Nate's company and his CEO. I was using somebody else different, and we had a lot of complaints because it took forever to fund, buying a property. And when we buy a property, we have a lot of timelines, right? So Nate, can you touch on what some of the timelines are? Let's say, I have a 401k, a self-directed IRA set up with you all. It's funded. I just want to write a contract for a property. How
Mhm.
long would it take to send that earnest money deposit?
So the earnest money can be sent, very, very quickly. And I'll start from the very beginning, just so people know. Opening an account takes less than 24 hours. Just fill out an application. The account's open usually the next day. Transferring the money in or moving the money in from where it's at now, that could take a little bit of time, but that's not something we can rush. That's all dependent on who it's coming from. Now, I will tell you, in most cases, if we're just doing a transfer from a Fidelity or a Charles Schwab, that could take about 3 to 5 business days. They're usually pretty quick. We send them a transfer request, you fill out, they wire the money over. But if it's a rollover from an old employer plan, just beware that might take 30 days or so, but that's because your employer takes 30 days, not us.
Mhm.
Once the account's funded though, and you've got the money in there, we try to live within a 24 to 40 hour time frame on turning in requests and sending money out, deploying the money out. So if you get us, let's say, a direction of investment form, and you get us the purchase contract for the real estate or whatever the agreement is, and those two look right, we can usually get the money out within 48 hours. Right. We do have some expedited service if you're falling behind schedule and you need to get it out. We can probably get it out the same day. I don't like to guarantee that, but you really got to make sure everything's correct, by 9 a.m. in the morning. I'll just be honest. Nobody gets it correct the first time. You don't know what you don't know, and you're kind of, you're asking a lot of questions, and it's just the way that it is. But once you get the process down, it's like riding a bike, and you'll know the timelines, and you'll be able to work with us and get things out. But we try to, work within that 24 to 48 hour time frame, and we've got great customer service. You go read our reviews, you can see our clients are happy. It's not like we don't make mistakes, but we make the majority of our clients happy, I would say.
Yeah, my mentors are really they're pushing Nate's company as well, and so that's how I found out about them. And of course, his CEO. I definitely hear about him. He's pretty well known. So
Yeah.
Corey has a question. So I would contribute to the IRA, and the IRA owns the property I would like to purchase.
Yes, yes. The IRA buys it, right? The IRA purchases it and we buy it. You're telling us to buy it on behalf of the IRA. So everything is bought and sold out of the IRA. You, as the client, are just quarterbacking the deal. You're instructing us what to buy. You're putting the pieces together. You're negotiating the terms, but nothing is ever in your name. You don't touch the money, right? The money comes in and out from us. And then we hold the document showing that the IRA owns it. Now, I will tell you this too, and we didn't touch on this, and I wasn't sure if we were going to have time. Like, you don't need hundreds of thousands of dollars either to self-direct. It really is all about what is the investment strategy. And the cool thing about real estate is that the creative real estate strategy still work in an IRA because all that's changing is IRA is the buyer. So I have clients that buy properties subject to using their Roth IRA. They take title to property, people that are struggling to pay their mortgage payments, struggling to pay their property taxes, and they catch up those payments, give some cash for keys. That's the investment from the Roth. And then they've got a rental property owned in their Roth IRA that the renter pays off the note, right? We have people that wholesale, right? What a great investment for especially like an ESA or an HSA, one of those smaller accounts that you might just start. I'll just give you an example. I've got a friend of mine, Alan, in Houston. He's a real estate broker. He's got a daughter that he puts through private school, and he never pays taxes on the money that he pays tuition with. He did one wholesale deal, okay, in the name of his daughter's Coverdell Education Savings Account, meaning he went out and found a deal that he could wholesale. It wasn't Alan's name on the contract as the buyer. It wasn't Alan's LLC. It was Alan's daughter's ESA account. Okay. The buyer on the contract was the ESA. The earnest money, the $1,000 he put in as a contribution to her account was used for the earnest money, okay, sent to the title company. And then he found an end buyer to wholesale the contract to for $40,000. And the $40,000 assignment came back to his daughter's ESA account, which pays no taxes. So immediately, once the 40 grand hits her account, he had to send a $10,000 check to her private school, and it kept the remaining $30,000 in to be reinvested or pay for future expenses. Had those earnings come to him, he loses 20 grand to Uncle Sam. That's the difference. All he did was do the same investment in a different bucket to pay for a need he needed anyways, private school, but did it in a cost efficient way to where Uncle Sam couldn't touch the earnings.
So it's not considered a distribution because he took it out to pay for the private
No,
school?
it's an expense. It's an investment expense. The EMD is an investment expense. It made an investment. It made $1,000 investment and it got a $40,000 return. Yeah. And the return isn't taxed because any distributions from the daughter's ESA, as long as it's used to pay for qualified education expenses, which are broad, anything from pre-K through college, even trade schools, even homeschooling, your home internet bill is a qualified education expense. He can use that money to pay for the internet in the home as long as his daughter's doing homework online, which is almost every kid. The only difference he just used the ESA to be the buyer and not Alan to be the buyer.
Right.
The ESA is not a taxpayer, Alan is. The ESA, the distributions come out to pay the education expenses that he has to pay anyways, but he just did it in a smarter way. He just did the investment over here instead of over here.
Man, that was a gold nugget right there. I did not know that. That's
Mm-hmm.
phenomenal. Man, that
Yeah,
was very interesting.
yeah,
Okay, so I don't see any other questions, so I have a question.
yep.
Um, this one I know, but I want to hear your take on it. Can you
Mhm.
buy a lot with your self-directed IRA, but build the house? Let's say you don't have enough money in your IRA, but
Mhm.
can you build the house with personal money?
The quick answer, no. Only because you can't have an investment that's not parallel when you have personal funds and IRA funds involved. So, example, I can't buy land in my IRA and then nate.hare come in with personal money and build the house on top. If I back the transaction up, let's say me and my IRA together buy the land 50-50. Okay. I'm a person, my IRA is a IRA. It can own it, okay, pro rata based on how much we put in. We can partner from the beginning. If we own the land 50-50, we could do the development on top at the same percentage, 50-50. As long as I keep the percentage parallel all the way from beginning to end, then I'm not creating what's called a prohibited transaction. But I can't have my IRA do one thing and me do something totally different. It
Yep.
has to be based on each of us does the same thing. The percentages don't have to start 50-50, but whatever percent I start with, if it's 70% personal funds, 30% IRA funds, I got to split every expense 70-30. And then also the profit has to come back 70-30 as well.
Okay, that's awesome. I knew that answer, but I didn't know you could.
Mhm.
The previous IRA company I was
Yeah.
using didn't tell me you could buy it 50-50 or 60-40 or
Yeah.
something like that.
And I'll be honest, I'm not a big fan of partnering with an IRA because it's a very easy way to get audited. It's a very easy way to
Okay.
mess things up. There's
Okay.
other ways to leverage other buckets of money. It doesn't have to be your money. I'll give you an example. My IRA can get a loan. There's banks that have IRA loan products. North American Savings Bank, First Western Federal, they have loans that work. I mean, if you're familiar with DSCR loans, debt
Yep.
service coverage ratio, if you show one of these banks the house or the property and you say my IRA is going to be the buyer, well, your IRA doesn't have a FICO score, your IRA doesn't have any income, but a DSCR loan, they don't care. They just want to see the property. They want to make sure the down payment from the buyer brings the mortgage payment down below what the rents in the area are. So if you go with a bank that's okay lending to an IRA, right, you just leverage their money, not your personal money. Have your IRA be a borrower, leverage some bank financing, and that's how you can get into some bigger properties with your IRA just putting down a down payment.
Wow, that's awesome, man. So something else you said piqued my interest that I didn't know. You said that I can invest in my self-directed IRA for 2024, up until That would be April 15th.
Yeah, you can make contributions to your
Okay.
IRAs for last year. Yeah, they give us until our tax filing deadline to
Okay.
make contributions to our IRA. So you can still make 2024 contributions if you haven't, if you're working on your tax return right now, look at it, make sure you make that contribution. And I will tell you, well, I won't get into that. Sometimes I think like, oh, yeah, but that's going to take me off into the weeds, and then people are going to have 30 minutes of questions. I'll save that for later. But yes, you can make contributions for 2024 right now, and you can still make contributions for 2025 since we're in the new year.
All right, good. And then what ballpark figure does it cost to set up and maintain a self-directed IRA?
$50 to open an account. With that promo, that $100, it drops our annual fee. We have an annual account fee, not an annual asset fee. A lot of companies charge per asset. We just charge per account. So $50 to open an account, 295 if you use my promo, 295 for the first year to have the account. That's for the entire year. That's our administration fee. And then $50 each time you need us to buy something or sell something. So roughly you're around $400 a year with us. Now remember how we charge. We don't sell commission, we don't sell investments, so we don't make commissions. There's no broker fees. We got to keep the lights on, obviously, and we've got a tremendous staff that help walk you through and sign documents and cut checks, and so very, very inexpensive. Most of my clients think, how do you guys keep the lights on? I'm only paying you a couple $100 a year, and you've got 12 investments that I have in my IRA. Again, so it is what it is. It's a numbers game for us. We like to see clients, just not get feed to death and still be encouraged to, invest in the things that they understand best.
Right. And I feel that's why a lot of the companies that invest in your stocks, bonds, mutual funds, they get paid under assets under management. So
Mhm.
if they lose your money because you're moving it to Nate's company, they're kind of not happy about that. So
Yeah.
so
Yeah.
just
Most
throwing
of
that out.
those, yeah, most of those big companies, I mean, if you really saw the fees that they charged, when
Yes.
you add up the broker fees, the finder fees, the commissions and all that, it's roughly about 1% of your account value. So let's say you've got a $200,000, IRA with Fidelity Trust, they're making 2 grand, you just don't even see it. The reason you don't see it is because you're like, oh, the stock market did great today. Why do I have the same amount of money?
Right. Right.
So it's because the fees are taken out before you even get the earnings. The fees are taken out in the trades. So
Exactly. Now you were talking about, your client and your friend that bought that fourplex and you had to pay the
mhm.
contractor and all that. Is there a fee for those payments to go out to the contractor and all that, like a
Yeah,
wire fee
usually
or
just a
something?
wire fee. I mean, the client would probably just picks a wire fee or an ACH fee. We're talking $10, $30 to get it
Okay,
out.
so it's very
So
minimal.
no big deal. Yeah, and we actually have a solution. If in some cases, if you're gonna, buy real estate or have an investment owned in your IRA that has a lot of moving parts, you got to pay contractors, you got to pay a property manager, maybe you've got multiple tenants that are paying rent. We actually have a solution. Not many companies do this, but we've got a sister company, KKOS Lawyers, upstairs. And together between Directed IRA and KKOS, if you choose, we can set up what's called a multi-member or IRA-owned LLC. Now, all this LLC does is it really just puts an entity in between the IRA and the investment. You don't need it. It's not required by law by any means, but it does alleviate a lot of the pain points if you're trying to have us cut a check to Home Depot and a check to this contractor and check. Sometimes it's just easier to just have the IRAs invest in an LLC. Um, we'll have an operating agreement that shows, and you can have multiple IRAs own one LLC. For instance, I've got a client that has 12 accounts with us. He's got a traditional Roth. The wife's got a traditional Roth. They've got 3 kids that all work. They all have Roths. They've got HSAs. They've got all these plans together. And instead of filling out forms every time to cut expenses, do all that, they just did everything once. They did one investment. All 12 of their plans own a multi-member LLC. Okay. The father and the mother are the managers of the LLC. Okay. Now, this does not give you the authority to take money out to yourself. Being the manager of the LLC just gives you the responsibility and the access to the business checking account for the LLC, which is comprised of all your plan's dollars. Now, what they do is they deploy money at the drop of a hat. They send wires, right? They cut checks. We don't even see the investments in the LLC, but on our books, it shows that their IRAs and their other plans own this LLC. Now, if they ever
Mhm.
want to take distributions, they got to send money back from the LLC back to us and take the distributions from us. But it does alleviate a lot of the paperwork that's involved. It saves them a lot of time. They can go in and out of investments. They can send international wires. So it does facilitate a lot of, solves a lot of problems. And again, I would say talk to myself or one of my IRA executives first before you go set one of those up, because I would say not everybody needs it, but for the right person, it does solve a lot of problems and make your life a lot easier and ours.
Yeah, wow, that's awesome. Um, so we kind of talked about this before we went live. There is something called a UBIT tax, and just high level, what is it for our listeners and people that are listening to this? How can we avoid it? Things like that.
So UBIT stands for unrelated business income tax. And it exists not just in the IRA world, but it's a tax on tax exempt entities. Okay. So just put it this way, a church is a tax exempt entity, right? The earnings generated through the church aren't taxed. But if the church opens up a bookstore or a cafe, the IRS says, hold on a second, you guys can have that income, but we're going to tax that income from that separate entity, unrelated to the function of the church. If an IRA engages in certain investments, and I'll just break it down simply. Usually it's on when an IRA invests into a business, when it owns an operating business, like the IRA is going to own a widget company and we're selling it widgets and selling inventory. The IRS says, you know what? It's going to be unfair for IRAs to own businesses and pay no taxes because nobody's going to want to own a business outside of owning it in an IRA. So they tax an IRA based on this unrelated business income tax. If you're not investing in a business, you don't have to worry about it. Where it gets real estate investors sometimes is when the IRA leverages other unrelated buckets of money. Back up to my example, having the IRA borrow money. It doesn't make it bad, by the way, but let's just say my IRA buys a $100,000 house and it only puts up $30,000, and my IRA borrows $70,000 from North American Savings Bank. In the eyes of the IRS, the IRA made a 30% investment, not a 100% investment. So if I just look at that simple math, my asset my IRA owns is 70% debt leveraged. So 70% of my IRA's profit is subject to a tax. It doesn't mean it's all taxed. It just means it's subject to a tax. So let's say I get a check from the renter of that house and it's $1,000. $300 or 30% goes right to my IRA tax free, but 70% or $700 is subject to a tax. Hold that thought. Just because my IRA is subject to a tax, now what does my IRA get to use that it normally doesn't get to use because there is no tax? As soon as there's a tax, my IRA can use depreciation and it can use the expenses on the property to offset the income. So if you factor in the mortgage payment as an expense, property taxes, landscapers, all the other things, when you really get down to it, that $700 of income is actually maybe $100 of net income because your IRA is only taxed on net income, not gross income. So if I oversimplified this, the tax is just a cost of doing business. Oftentimes, the debt that your IRA uses helps it buy things it couldn't buy otherwise. The same thing goes with syndications and multifamily. People get freaked out that their IRA is going to have to pay a tax. It's like, hey, you wouldn't have been able to buy the $10 million property without the debt. So,
Mhm.
and if your IRA is subject to a tax, that means it made money. But the thing is that now that the IRA gets to use depreciation and expenses, it's a cost of doing business. You want to factor in the cost of the tax, okay, and measure that to the cash on cash return that you get. In almost every scenario, if the debt is used responsibly, the cash on cash return is higher even after paying the tax. I had a doctor friend buy a piece of land in Las Vegas with an IRA, and he bought his IRA borrowed a 60% loan from his community bank. Um, Even after paying the tax, he made a cash on cash return of 68% because again, his IRA only had to put a $40,000 down payment down. Okay. Oh, and by the way, your IRA can use long-term capital gains too, as long as it holds the property a year and a day. So it's big whoop. But even after paying the tax, his IRA had to pay a very, very small tax. His cash on cash return was 68%. We ran the numbers just for the heck of it to see, well, what would have been his cash on cash return had he not used the debt and not had the tax? His bottom line was higher. He made more, he would have made more money, but he would have had to come in with 100% of the purchase price. He would have had to
Right.
lock his entire IRA down on just a land purchase, and the cash on cash return was actually 40%, not 68.
Oh,
So
wow.
what that enables you to do is buy more property with the ability to leverage. And if you pay a tax, you pay a tax, but you get to buy bigger things or you get to buy more investments. And it's the cash on cash return you want to look at, not the fact that you got to pay a tax.
Right. Can you do a 1031 in your IRA?
You can. I haven't seen anybody do it yet, but you can 1031 if you've got a remaining amount of tax in
Hmm.
there. You can defer that amount of tax over, and you can even carry forward losses. There's a lot of situations
Hmm.
where the IRA might invest in a syndication or a commercial property, and it's got losses the first couple of years. And well, guess
Hmm.
what? If your IRA is an investor in that, and there's debt on the property, you can use those losses to offset future income. So again, it's like not it's no big deal, and oftentimes what I see, the tax is a lot less than the people expected it to be. And
Right.
oftentimes it just allows them to make more money, more return through the leverage piece.
Wow, that's awesome. So Corey's asking, is there any legal issues with property? Is there any support for that? And are the IRA insured? So is the money in your IRA account insured?
Yes, I mean, so the cash with us, we're regulated just like a bank. So all of the cash that we hold at Directed IRA is FDIC insured. Now your assets are secured by the documents we hold. So if you think about it, if David has a deed here that shows his IRA owns this property at 123 Main Street, if Directed IRA disappears, that ownership doesn't disappear. It just means that David has to find a new custodian to hold the deed for it. So your assets are secured by the documents that show the ownership, and then your cash is insured through obviously FDIC insurance. There's another piece to that question that he asked. What was the question again?
Yeah. Is
I
there
thought he was
any
going somewhere
legal
else with that.
issues with property?
Okay.
Uh, and I'm not sure what Corey, if you want to kind of explain that a little bit more, because I don't really
And I
understand that
will say
part of it.
this, and this might not be exactly what he's asking, but it's good food for thought. The legal ramifications when it comes to self-direction, the one thing you want to be aware of is that the IRS doesn't care about what we buy, but they do care about who we buy it from. Because your IRA is an extension of yourself, you're just a fiduciary to your IRA. Your job or role to your IRA or your 401k is to make it grow. That's your job. Put money in it, put investments in it, and then you get your benefit from the distributions. That's the only way you're supposed to benefit from the distributions. So if you want to stay out of hot trouble, you want to stay out of the legal courtroom with the IRS, you can't tell your IRA to buy stuff from you. That's a conflict of interest, right? Your IRA is not going to tell you no. So if I own property right now as Nate Hare, I can't sell my rental property to my IRA. It's a conflict of interest. There's other people IRAs can't transact with either. And these are called disqualified people. This is really the biggest rule that you want to understand. IRAs can't transact with the IRA owner, can't transact with their spouse, parents, kids and grandkids, and their spouses. So it's a specific list of family: me, spouse, parents, kids, and their spouses. The reason they disqualify those people is when you die, your spouse or your kids are usually one that inherit your IRA. So they deem them as fiduciaries to the plan as well because they're going to get it when you die. Brothers and sisters and aunts and uncles and cousins and nieces and nephews in the IRA world, they're not considered prohibited. They're not disqualified parties. So could my IRA buy a property my brother owns? Sure, it could, right? Do I want to buy a property my brother owns? Maybe not. That's a whole other conversation. But when it comes to the legal things you want to be aware of is that you can't self-deal your assets to your own IRA. And
Mhm.
there's some case law as to how active you can be on an IRA owned investment. I'll just kind of, if you're using your brain, you're fine. If you're using your brawn, you're probably not fine. And what I mean by that is, let's say my IRA owns a property and it's got to be, there's got to be a rehab done. Okay. I can pick the property my IRA buys, fine. I can pick the contractors that work on the property, fine. I can't be the contractor. can extend services or work on the property owned inside of my IRA. They look at that as an extension of a service. They also look at that as an excess contribution. You're contributing skill and labor to the account, and you can only contribute cash. So you just want to stay arm's length from the investment, the pieces together. And honestly, you should be focused on, what you do in your day-to-day life. Let your IRA grow off the sweat equity of other people and find investments that cash flow and appreciate, but they don't have to be the assets that you work on personally. Work on those assets outside of your IRA.
Exactly. Good point. Good point. John, we see your question, and I'll let you talk in 1 second. I just want to get to um, Mr. McKinsey. I'll answer yours. And Bo has a pretty simple question. I think I know the answer, but I'll let you answer. Do you need to hire a separate CPA to handle the tax reporting for real estate investments in your IRA plan?
Well, if you don't have any UBIT, there's no tax reporting. You just work through us. There's no annual tax return an IRA has to file. There's really nothing you have to do if your IRA just owns property that you're not subjecting the IRA to a UBIT tax.
Mhm.
If a UBIT tax is involved, that's owning debt leverage property or owning a business, it might be worth having a CPA file. Again, it's a form called a 990T. That's a tax form for tax exempt entities when there is a tax to pay. That would be the only circumstance you would need a CPA to get involved, is if your IRA was doing something creative that was creating a tax to the IRA itself. But again, if you're just buying stock, cryptocurrency, property, if you're doing private lending like I do, I don't own anything in my IRA other than notes. I'm completely passive. If you're passive in your investing, you're never going to see UBIT in your life. It's only when you own something in an IRA, and that asset that it owns is a business or property with debt. And I will tell you, there's another solution to that tax on property with debt. If you're self-employed and have a solo 401k, you don't even have to pay tax. The 401k doesn't pay taxes on debt. So your 401k, your solo K, can borrow as much money as it wants, and there's an exemption to the UBIT tax on debt leveraged investments if you use a 401k instead of an IRA.
Wow. Um, can you pay the CPA fee through your self-directed IRA?
You can, yeah,
Yeah.
you can. Yep.
Okay. Also, most CPAs will know how to deal with this. If you don't, I would assume you don't have a good CPA. I mean,
I
these
would use
rules
a
are
real
pretty
estate CPA. Real estate CPAs usually get it.
correct.
Yeah,
Correct. I
yeah.
mean, this is all common stuff that the wealthy use. It's just just like if you have a toolbox, if you're a contractor, you have a shovel, a hammer, a screwdriver. This is just another tool in your toolbox
Yeah.
for investment. Um, David, how much is the land tax in Belize? It's very cheap. It's 50 Belize dollars an acre. So $25 US for property tax in Belize. My house in San Pedro, I pay 180 Belize dollars a year, and my house in Placencia, I pay 25 Belize dollars a year. The biggest difference is one is a town, if you will, and the other one's just a village. Um, so Mr. McKinsey was asking too, real quickly, and Nate, you good with time
Yeah,
or
yeah,
okay.
yeah.
Um,
I can hang tight.
Okay. We just passed a law, or the government just passed a law about the Movable Property Secure Transaction Act of 2024. And basically, what that means is if you are buying a house in Belize and you're getting a local loan, you can use, let's say you have a farm as well. So we take,
Mhm.
for instance, my chocolate farm in Punta Gorda. We can take the tractors that we own, the farmhouse, the weed eaters, blowers, all of that equipment, chainsaws. We can take all that list of equipment and go and add that to the capital stack, if you will, where the bank will give us a percentage of that money back. So that's it's very, very new. I've not even heard of anybody use it yet. I'm supposed to meet with my banker in a few weeks, and
Mhm.
they will, let me know kind of, what it is. We're 10 minutes over. It was good questions.
Yep.
We could have went down so many rabbit holes. Usually Nate is giving a couple, a couple, um, what do you call it? A couple hours talk. If you're looking at our chat box is his website and his email address and my email address as well. So reach out to him. He's a wealth of knowledge and he'll help you navigate all your questions when it pertains to self-directed IRAs. So Nate, thank you so much for your time. And thanks everyone for joining. Stay tuned. We'll make announcements for our next. It'll probably be the same time or same date next month, but we'll let you know what the topics are as well. So thanks everyone. Have a great evening.
See
Thanks,
you
Nate.
guys. Thanks for having me, David. It was a lot of fun.
Yes, thank you.